Well, first of all, if the tariff is passed back to the consumer, then obviously there's going to be a sentiment to shop in the locations that will provide the consumer the best bang for their buck, where they can get great value. And I think where we live is in that value sweet spot, right? Obviously the outlet business, value every day, great brands. So, we've gone through many cycles. We're a 43-year-old company. We're public over 30 years. And through those cycles, we've endured large tariff increases. We've endured cost of goods sold increases. And because of that, the consumer really finds our channel, and it's actually a safe spot for them to go and get things they love at the best possible price.
We'll talk about those past cycles, those past experiences you have. When you look to 2016, for example, do you have a blueprint for how, of course, the retailers that you work with might respond? What does that typically look like, and what might investors expect?
I think, first of all, the consumers are selling out. Now, most of the retailers in our space have a full price channel. They have an online channel. Some of them have a wholesale channel where they're distributing through department stores. And they actually look at the value channel or the outlet business to be a place that they clear excess inventory. So should they find buildup of inventory in their full price stores or their online channel, they can quickly move inventory into our sector in order to close it out and clear it at, like I said, at value price. In some instances, meeting that consumer where they are and getting a great return on sales. And in other instances, just liquidating inventory and turning it into cash.
It's interesting. When we think about the tariff policy, a lot of people think inflation immediately, but the bond market thinks about that too. You have seen tremendous volatility this week alone. You are now seeing long-dated bonds really start to correct, if you will. You're starting to see a bid back into them. The rates are not as high as they were Wednesday. And so...
Or as they were Friday.
As they were Friday. So how do you think about this as somebody with a large real estate footprint? Is that volatility a problem for you as you make plans into next year?
Well, first of all, we've got about $1.5 billion in debt. Now, we don't have a major tranche coming due until late in 2026. We did have a large tranche that came through this year that we had to refinance. And, obviously that was an interest rate headwind for us. We see the rate cut that happened yesterday as a positive thing for us as we think about refinancing. But we've got great access to capital. There's a strong acquisitions market out there right now. And we bought 2 centers last year, and we're definitely in the game with regard to buying new centers on a going forward basis. And, with our access to capital, I think it puts us in an advantaged position to go out and source and ultimately close on some new product.
I wonder how the consumer looks to you. As I said, we got University of Michigan data, and it's not clear how much of the election it encapsulates, but it still is strong. 73, we were looking for 71. We talked to Erin Brown from PIMCO earlier today, and she says that the consumer has remained resilient overall and focused on value. Is that what you're seeing as well?
It is, and the retailers are saying the same thing. I think that there's a strong push to, there's always going to be a push to brand. We read the latest on luxury and sort of the bottom falling out of the luxury market a little bit. But great brands, great apparel brands, the American accessory brands like Coach and Kors and brands like that, Kate Spade, seem to still be fairly resilient, and we think that they're going to have a great quarter, particularly going into this.
And you have those. You have Ralph Lauren. You have Nike. What are your biggest brands?
We do. Those are our biggest brands.
Yeah.
And for us, it's also the customer. Look, we have to fight like everybody else to get the consumer into our shopping center. They're not just going there for value; they're looking for entertainment too. So I think that's a really important part of what we do as developers. Is we want to make sure that we're bringing a full. A full concert of things for that customer to do when they come and shop with us. That's why we've gone after better restaurants. That's why we've gone after better entertainment uses, to fill some of that space, to give that carload of customers who come and shop with us. The shoppers will shop. Some people in that car aren't thinking about shopping. Will go, play putt-putt. They'll go to Pop Stroke. they'll go to Shake Shack. So we're looking, we're competing to get the customer into our centers.
So a mix, of course, of physical goods and actual experiences. I want to talk a little bit more about some of the brands. Let's name drop a little bit more. You have Warby Parker, Victoria's Secret, Ulta, Sephora. That's interesting too on the beauty side. What are your best performing categories right now when you consider apparel versus beauty versus restaurants, for example?
And I just looked at that, and what's so interesting, they're not performing by category, they're performing by brand. So some of the brands that you just talked about, Brooks Brothers is performing really well with us right now.
Wow.
Exactly. Sephora, we put 5 new Sephoras in our portfolio, brand new to outlet. Now, they're selling mostly full price product in the outlet environment, but they see an outlet customer, they see it as an opportunity to meet a new customer where they are. And we just did, as a company, a day of beauty. And basically what we did was a local advertising campaign in most of our markets that have either Ulta, Sephora, also Estee Lauder has cosmetics company, which is pretty big in the outlet space too, to bring that customer in, that local customer in to shop that particular brand. And it turned out to be a great win for us. So that category is doing extremely well.
So some of these brands you've named, one reason they have been under so much of investors' kind of focus here, Brooks Brothers bought in 2020 by Authentic Brands. You mentioned Coach, Tapestry. Deal fell through there, but you gotta wonder if in a new administration those deals come back. How do you view this potential? Do you think there's gonna be more consolidation among those brands? Is it good or bad? What does it mean for the American consumer? You experience kind of a very intense view of that from where you sit.
Well, look, Tapestry is an operator, probably one of the best operators out there. When the deal fell through with Michael Kors, my personal opinion on that was, it would have been great for Michael Kors to benefit from the Tapestry leadership. But Michael Kors again is a great brand that's got great resilience, and I think I think of consumers as fans of brands, particularly in our space. I think of the consumer as a fan of a brand. They're not shopping with us to just go find a jacket or a polo shirt or a pair of jeans. They're very focused on the brand that they want to buy. They want sneakers, they want to go to Nike, or they want to go to Adidas. I mean, it's one or the other. You're not comparing which one has the better deal that day. But you're very fortunate that in our centers, Nike's on sale every day, Adidas is on sale every day. I just think that that's the consumer wants the brands they love at the best possible price. That's what we get to deliver to them. And I think the best retailers are the ones that are focused on that and delivering that product and making sure that the inventory is there, that the customer service is there, because that's the main differentiator between online shopping and in-store shopping is that customer service element. And the people that are bringing the best customer service to the table are the brands that are really winning right now.